Okay, so our next panel, sponsored by Cohen and Company, will touch on SMA conversions into ETFs, including touching on our favorite topic of tax implications. Ooh. Jay Larilla, partner at Cohen and Company, will be moderating. Thank you.
Thanks, Steve. Good morning, everyone. And as Steve said, please brace yourselves. We're going to talk about taxes. My name's Jay Larilla. I'm one of the partners at Cohen and Company. I'm a tax partner. If you don't know Cohen and Company, we are an 800-plus person accounting firm headquartered in Cleveland, Ohio, with 14 offices across 8 states. A large part of our business is auditing and tax advice to the registered funds industry, so ETFs, mutual funds, closed-end funds. We audit over 1,900 registered funds products, and we are the second largest auditor based on number of issuers of ETFs. And if you count number of unique advisors, we're the largest auditor of ETFs. Me personally, I work out of our office in Milwaukee. I've been with the firm about 8 years. Before that, I was at a Big Four firm in Chicago. Been working with investment entities my entire career, private funds and public funds. I'd like my panel to each introduce themselves for a few minutes, and then I'll set us up. Morrison?
Sure. Hey, I'm Morrison Warren. I'm a partner at Chapman & Cutler. I chair our investment management practice out of Chicago.
Hello, my name's Rafael Zayas. I'm the Senior Vice President and Head of Portfolio Management and Trading for Vidant Asset Management.
Hi, I'm Elizabeth Marchetti here on behalf of SEI. I guess I would describe myself as kind of an ETF, cap markets, and special projects person within our investment manager services division.
Okay, as you'll notice, I'm the only tax professional on the stage, so there will actually be people who can try to communicate this in non-tax language. But our panel is unlocking Section 351, which is best practices for seeding an ETF via SMA conversions. So it's pretty rare when a tax professional actually puts an internal revenue code section in front of a non-tax audience. But 351 is something that is known in the industry as the section that allows contributions of appreciated property to a corporation. So it wasn't written for ETFs, it wasn't written for funds, but ETFs are typically regulated investment companies for US tax purposes, or RICs. And those RICs are corporations that make an election to be treated as a RIC. So we can rely on Section 351 because it's a corporate section. And what it allows you to do is take appreciated property and contribute that appreciated property to a corporation without tax consequences. So a shareholder would contribute property to a corporation. In exchange for contributing property, they would receive shares of the corporation, in this case the RIC or the ETF, and then everyone moves on. Now there are a couple of basic tax requirements to 351 that I'll say now, and I'll turn it over to Raphael and Elizabeth here in a second. To say now, before we go a little deeper, there are two. One of them is that contributors to the corporation must have control of the corporation immediately after the transfer. That control is defined as more than 80%. So the contributors to the RIC, the ETF, need to have 80% ownership immediately after the contribution. That's rule number one. And rule number two is the portfolio that is contributed must be diversified. So if you've got a client coming to you and saying, hey, I've got this concentrated NVIDIA position that I've been holding for years that's now run up, can I contribute that to the ETF? The answer to that question is yes, if A, you want to pay tax, or B, you have a concentrated portfolio, or you have a diversified portfolio of securities that you can contribute along with that security. So I'm going to stop there with the wonky tax and give it over to Elizabeth and Raphael to start us with, how does this conversation with your advisors get started?
Yeah. So in my seat at SEI, we work with a lot of third-party asset managers, and I think we can kind of pick up with the idea that the exchange panelists established really well, which is right now a lot of new entry into ETFs is established asset managers. Not really kind of the ETF pure play companies that have dominated most of the industry's history. So these established managers, they have very long-standing clients. They have long-standing strategies, and a lot of times what that means is that they've got a tail or kind of a population of highly seasoned, highly appreciated accounts that create a lot of friction. Tax management creates a fair amount of friction relative to the investment process. Operationally, it's very difficult to scale that level of handling in terms of taxes. And at the end of the day, the client may not be getting the investment manager's best thinking from a portfolio perspective. So 351 becomes a very attractive way to consolidate operationally, to scale tax management going forward, and to move clients from an SMA to a more tax-efficient vehicle in a tax-efficient manner. So there's almost no conversation that we're having with established asset managers that doesn't begin with, what is that 351 thing? Am I a candidate? What is kind of the checklist that I need to be thinking through? What are the additional costs?
Yeah, that's right. I think if for people who've been following the ETF kind of media in the last few years, the big thing about a year ago was the mutual fund conversions, right? And so this is kind of the other side of that, where these asset managers have a lot of SMAs, a lot of client SMAs. We're seeing hedge funds with clients who in concentrated portfolios in a disadvantageous tax position, and so a lot of these asset managers are looking at how can we consolidate positions in a way that lets them be managed. Now, the cost base, I don't know how much we want to get into the tax side of this, but what happens is it's not that they completely reset their cost basis, right? They're taking on ETF shares with the same unrealized gain they had before the transaction. But what happens now is once it's in these assets are in the ETF wrapper, we now get to make use of a lot of the ETF mechanisms for tax management, including the create redeem process, in order to manage the taxes on that portfolio. So at least instead of deviating from the manager's intended strategy, the manager can implement their strategy using all the tools of the ETF wrapper.
So taxes aren't forgiven. If the basis of the securities you're contributing was $10, your basis in the ETF is $10. So
Exactly.
the conversion is only half the battle, which I think you had established much more professionally, Jay, but that is something really important to understand. The 351 is just getting to a more tax-efficient vehicle without a lot of upfront pain.
Right, Elizabeth. So this works for a portfolio manager who has SMA accounts, typically a large number of them, who has portfolios of securities that all the SMAs are similar in a similar strategy, and you could put that entire strategy into an ETF because the portfolio managers will sometimes look at a security that's run up a lot and say, well, I don't want to sell that because my clients are in taxable brokerage accounts and I don't want to give them a tax gain. If you put that in an ETF, you can make that portfolio management decision to quote unquote sell, really use the redeem in kind function that Raphael described in order to defer, not eliminate, defer the capital gains tax impact for your clients. That's the magic of 351. Okay, so anything else that Raphael, maybe that managers need to evaluate when they're starting to think about this?
Yeah, I think the one thing that gets kind of people, I think people are very hyped about deferring taxes and potentially avoiding taxes, rebalancing a portfolio without having to incur the realized taxes right now. There is the investment perspective on that as well, which is that Jay mentioned, the strategy should be similar as that are being contributed, and then on an ongoing basis, your investors are going to have that ETF, right? So I think a lot of people see or hear about, tax deferment or tax avoidance or whatever they hear, and the problem, they're going to have a new investment vehicle, and that has to work for the clients as well. And so, and not only that, it is the case that, and Jay's going to correct me if I misspeak here, but the tax opinion, which allows you to not make the transfer a taxable transaction, kind of relies on there being an investment thesis behind the transaction. It's not just a tax transaction. Jay could probably word that better than me, but I mean, the investment outcome is a key part of this, and so we can't just say, oh, we'll do this for taxes and not worry about what happens after.
Yeah, so I think what you're describing, maybe I'll try to describe this way. I have a master's degree in taxation, and the first day of grad school in tax, our professor got up there and said, okay, there are two fundamental rules of tax law. Number one, death is always good. Number two, pigs get fat, hogs get slaughtered. Okay? So it is drilled into us as tax professionals for number two that you cannot do things just for tax reasons. There has to be a business purpose behind it. And if there is a business purpose behind it, you're going to have a lot more strong footing to stand on from a tax perspective, because a lot of these rules aren't bright line tests. This 351 one happens to be, but what you do with the securities after, and we'll talk about that in a bit, is not. And so you're living in what kind of position can I create? How comfortable can I be in the position that I've created with, you know, these securities in my new ETF? Is that what you're trying to say?
And Jay will say
Exactly.
that having a purpose other than tax, when you're thinking about putting someone in an asset that is more liquid and more transparent and easier to trade, we get there in all cases. But yes, of course, that's a major, this just can't be to avoid taxation, but it isn't too difficult when you're talking about two different exposures to find a non-tax reason to get there.
I think that's right, Morrison.
And I mean, how we try to explain this quick and dirty to clients is like, the accounts need to have some relationship to each other. It must be clear that there was some relationship between the strategy that was being pursued by the contributing accounts, and there's got to be some relationship of what you're contributing to the long-term investment strategy. This is still a registered investment vehicle. This is back to the investment thesis, but where that lack of kind of bright line on this issue comes in is where clients are like, well, the whole point of this being attractive is tax, but also this very long-term portfolio has become a Frankenstein because the tax tail is wagging the investment dog. Is that okay? Is it okay to have a portfolio that doesn't match the model anymore because we've been at the mercy of capital gains issues? So I think that's fine, but that's where coordination and a lot of communication with fund counsel, with your tax or audit partner comes in, is figuring out what is enough to sort of attract, the IRS's attention. And that is the purpose, I think, of the tax opinion, is to protect or to sort of vet the thesis behind the transaction and the relationship of what you've contributed to what you're going to run as an ETF going forward.
Right. So I want to pause right there, Elizabeth, because that's a great point. But before we talk about the tax of that, Morrison, can you talk about like just how this is complicated from a legal perspective? What does the SEC have to say about this? Are they looking at these transactions when you file? All of that.
Sure, and yes, the SEC is aware that these transactions are taking place. And when you break it down, so what's happening, and let's say we're specifically talking with an SMA, you have to have a circumstance where there is a fund to be created. That fund is making an offer. An offer is obviously a whole series of rules and requirements associated with offers that have to be fulfilled. Investors that are in the SMA ultimately, generally, they have some say as to whether this happens. That has to happen at the advisor level, and so there are various levels of concern as it relates to the securities laws. There's fiduciary duty concerns at the advisor level. There are disclosure concerns at the fund level. And this is sort of orchestrated to all happen at a given point in time. Oftentimes, these assets are seed assets, and so they are the first assets into the fund. You normally want to sell registered shares to those investors, so there aren't restrictions on those shares. There are disclosure obligations in the registration statement so that there are free resales, because there are potential restrictions on resales for parties that are affiliated parties, and because of that control aspect Jay was speaking about, there are affiliations through ownership, and so there is a lot going on that has to be orchestrated. But the good part is like there has been a path established. There is a way to do this, and there's a way to do it efficiently. And all the players, tax, the regulatory lawyers associated with the advisor, the securities lawyers involved in offering the funds, and then ultimately the administrators and all the parties involved in offering the ETFs sort of have to work together to make this work.
So let's talk about the IRS for a second. I mentioned that the control test is one of the two tests and the diversification test is the other. Those are the two bright line tests that need to be met: to control at least 80% of the fund and diversification on the way in. Those aren't the only two considerations that we think about, though. When you look at, let's use an extreme example. Let's say you've got 5 SMA accounts. They're all large cap equity. But you want these assets, but you're going to change the strategy to, I'll use an extreme example, a taxable fixed income fund. So a few days after the transfer, you in-kind all of the securities out to the authorized participant without tax consequences, and then you buy new securities that are fixed income securities. That position would likely be challenged by the IRS because you haven't continued the business of what you were doing before. So to a point that Elizabeth made earlier, these securities have to have a relationship to each other and a relationship to what you want to do in the ETF. That is not to say that 100% of the securities need to stay for a specified period of time. You know, we can get comfortable with less than that, and in some cases significantly less than that. But the question that you're going to talk to with your attorney is, what am I doing with this portfolio? How do I intend to rebalance these securities, and when do I intend to rebalance these securities? Market forces that happen after the contribution are different. What's the plan on the way in? You know, do you have a plan on the way in to say, this is what I plan to do? Yes, there is tax benefit here, but this is a business purpose of getting these 5 SMAs, in my example, into this account so I can run this portfolio efficiently together.
So like Jig or Morrison too, I mean, an example is like if historically the portfolio has held Pepsi, but this one client inherited a position in Coke, and you've kind of permitted that and still managed that as part of the strategy, there shouldn't be any real, you know, wariness around contributing that as part of it. There is an investment thesis behind inclusion and contribution of that position.
Yes, that's
And
right.
that's reasonable.
Yes, that's right.
Yeah.
And ultimately, an ETF has a purpose, a theme, an objective. And so the contribution, the assets should be in the furtherance of that objective. It's much easier to defend. Not all assets will continue to work. We've seen circumstances where, you know, the SMA conversion to an ETF through this process is the easiest to see. You have something that ultimately gives the advisor, who may even advise the ETF afterwards, or sub-advisory ETF, gives them a leg up into the ETF business. All of a sudden, you're instantly in with assets. You have scale. That's the easy story. We see other 351 stories where folks with significant exposures in 1 or 2 assets are looking to create an ETF where they have the ability to move assets without gains. There, you have to have an investment thesis that works, and then ultimately you can't avoid the diversification rules that Jay had mentioned. So they have to. We've had some circumstances where, you know, their goal would be to contribute, you know, X amount of a given asset, and they've been able to contribute just 1/4 of that because there's a 25% limit on the diversification test. You know, those are things that end up happening. But in the end, you need an investment thesis for the ETF that is ultimately going to work, and you need a marketable ETF, because an ETF that doesn't trade ultimately doesn't work. And having an ETF that survives is important.
Okay. Raphael, tell us about some other pain points. Let's hear some more stories.
Yeah, so the big thing I'd like to kind of just bring up right now is that this is quite an arduous event for an asset manager. Now, we can all do this, and there's plenty of people in the industry who can help, but this is going to take a little bit, it's going to take some elbow grease to get this over the finish line. First of all, you're going to have to confirm with all of your clients who are SMA account holders that they are going to be part of this, right? And that is itself a whole game of herding cats. Separately, just the custodian and accounting data transfers that need to happen are generally considered pretty onerous by most asset managers, right? So a lot of what I do is actually, I would call it operational therapy. It's literally just listening to the ops people, these asset managers. Yes, this is painful. Yes, you're out of your comfort zone. We're gonna get through this. And then just sitting in meeting, just explaining this, because in the weeks leading up to the event, there's gonna be a lot of planning meetings. People are going to be a lot of operational folks who handle the cost basis stuff at these asset managers, who have been kind of doing good work for a long time potentially, or just completely unfamiliar with what you're talking about. And so bringing them up to speed, making sure they know how to do what they need to do the day of the event, can take a lot of work. And so a lot of assets are transferred through DTCC, through the custody. There's a lot of cost basis work that needs to be done. There is the golden rule is that for all the Well, first of all, there's basically two golden rules. For every contributor in that control group that Jay mentioned, for every contributor, the market value they give out in securities has to equal the market value of ETFs and potentially a little bit of cash that they get back at the end. And then secondly, the cost basis has to match in and out. And so getting there when you...
This is lot level. So if
Yes.
ETF tax alpha occurs at the tax lot level, not like the average position basis, this transaction depends on lot level historical data. So you have to confirm your custodian has that history. Also, your SMA custodian is going to resent you for involving this and this
Yeah.
for involving them in the process
Yes.
because this isn't going away, but it is really disruptive for them. The SMA custodians don't have task force designed to attack this problem. It's disruptive. They make no money on it. It's labor intensive and it's new to them. I mean, good ETF
Yeah.
citizens like Raphael are providing a lot of education in that process as this industry practice grows. But I think the SMA custodians telling them early, getting a real plan of attack is only going to benefit your efforts in this process.
Absolutely.
And I think it's worth mentioning, it's so critical to have that cost basis information because the only reason why these transactions are allowed is that there isn't the sort of the conversion of or loss of potential revenue through the modification of the cost basis. So you have to have absolutely perfect cost basis information that you trust because the ETFs are going to assume that that cost basis. And so if there is a break in that chain and there can be difficulty with that, then you ultimately can't do it.
Yeah, exactly. And then, and to that point, so when you're getting down to the cost basis information, you're talking about quite seasoned accounts. Asset managers may have clients who predate all the modern accounting systems that they use, right? So for a recent 351, the manager literally had to have the client kind of go through self-reporting kind of exercise or figure it out, and they had to input all this historical data that was not in their systems in order to get the cost basis data in order to pull this out. And then if there's data entry issues there, that's something else. So anyway, it's quite involved from a tax law perspective. It's very doable. Again, market value equals market value, cost equals cost for each account coming in and out. You should be good. Just getting there is, in my opinion, quite more onerous than people might suspect at first glance.
Right, because you need that lot level information. Because if you have a volatile security, when you're deciding, maybe this is a good segue into the what happens after portion of this. If you're deciding which lots of a particular security to send to an AP in a rebalance in-kind transaction, well, you're going to want to pick the lowest lots, the ones that have the most unrealized gain. And a lot of times those are going to be the ones that were contributed in the 351 transaction. So you're going to need to know which lots to pick. I've run into situations where, I had an administrator recently who they picked certain lots for books and they picked other lots for tax purposes. And we said, no, you can't do that. So it's really important that all those records, as Raphael said, come in clean. Every lot, every account.
Oh, one other point on that is that, this is a good point. After you do that, you would think that your default tax lot relief methodology or your custodian may apply. The many default lot relief methodologies kind of have a preference for long-term lots, which might really bite an asset manager in the ass. Basically, if you're not thoughtful about that up front, you want to be thoughtful about your tax lot relief methodology.
Yeah, because there's no requirement for a tax lot relief method. The general rule is FIFO, but you can elect to do specific cost.
Yep.
So if you're doing spec ID, sometimes what you'll want to do is send the low cost lots out using the in-kind feature, and if you're selling in the market, you would sell the high-cost lots because you don't want to distribute to an AP lots that are at a loss, tax loss. Mm-hmm. You want to sell those lots in the market, take that loss, include it as a capital loss carry forward for regulated investment company tax purposes. Those carry forwards are unlimited in terms of when you can use them. They do not expire. So a lot of ETFs will build up, a bank of losses for the future, in case something happens, and that's why you don't see capital gains distributions in an ETF because they're taking all of the gain lots and sending them out in kind to the APs and taking all the loss lots and selling them in the market. What else on the rebalance?
So now you have a new ETF. You've worked through all, you've done all the work, gathered, gotten all your clients to sign whatever papers they needed. You got your ops teams to kind of send the assets over. You ticked and tied every fourth decimal place for every tax lot, and you have a new ETF. Congratulations. Now what do you do with it? And so the question is, you're going to want to rebalance that. The part of this is to kind of maybe the strategy of the contributed assets wasn't perfectly aligned with the investment strategy of the asset manager. And so as to facilitate that rebalance, I believe, and I think a lot of people believe, that first round of custom redemptions that you may want to do, probably going to be a lot more scrutinized than the standard rebalance process on a going forward basis. I think that's very fair to say. Jay's nodding his head. I'm got on good ground here. So you do want to make sure that, if in the example of you want to deliver out Coke to swap in for Pepsi, that's probably going to stand good ground. If you are massively turning over the portfolio in order to bring in a whole other set of new assets that don't reflect the investment strategy, that's going to be a problem. And so you really want to be thoughtful and very likely work with your tax attorney to kind of identify what's a good and reasonable rebalancing strategy for the weeks and months after the 351, so that you don't, because what you don't want to do is risk the tax opinion for your clients as an asset manager, right? You don't want to make that. The downside is, and Jake will get to this, the downside, I believe, is that becomes a taxable event and your investors are on the hook for taxes, right?
Right. So let's talk about that. So something goes wrong, and the government comes in and challenges your position after the fact. What happens? Well, your ETF would be over distributed because you brought lots in at a low tax basis instead of at market value on the day of the contribution. So you would have distributed more than you are required to, either through the in-kind process or to shareholders. So the risk to the ETF is not that much. There's no tax paid. You're not under-distributed, which is a huge problem in regulated investment company space. You don't have a qualification issue or any diversification or anything like that. There's really not that much risk. Where the risk is to your shareholder. Because if the government were to come in and say, no, that transaction was taxable, now that shareholder didn't pay tax on those capital gains that he or she should have when it happens. Now you're looking at back tax, you're looking at interest, you're looking at penalties, you're looking at a prolonged fight that you don't want to have.
I would say, too, if there's an expectation, if that investor who contributed assets had the expectation it was going to work, and then ultimately it didn't, then there are possibly implications also for the fund sponsor. And so this is something that our thinking is that everyone has to agree as to how this is going to go, so there are no surprises. Because there are different views as to the appropriate time frame to hold given assets. I think you have to be on the same page and comfortable, and it has to align with the tax opinion you're getting. Otherwise, you're just booking risk.
So, I mean, the advisor is, so besides the bright line areas that you mentioned, like a lot of this stuff, how aggressive can I be when contributing, maybe not strictly related positions? That's the advisor's risk appetite, but the shareholder is actually going to bear that risk, basically, of something going wrong or the IRS challenging on the basis of some unmet criteria. So I think that that's really, we spend a lot of time on the front end with managers talking through that. Because, of course, everybody would love to just wing their run-up NVIDIA position and get, diversified ETF shares back. But putting at risk the shareholder in order to solve that problem in the short term is just not what we want to see.
Right. And I mentioned we have the two bright line tests, the control test and the diversification test. But all of this that we're talking about appears nowhere in the tax code, appears nowhere in the tax regulations. There is some case law authority for this that goes back decades. There is a very old revenue procedure that from, I believe, 1987 that talks about a fund that turned its portfolio over from a muni bond portfolio to a taxable bond portfolio is not in the same business, so they can even get that granular. Okay, what else before? I'm sure there'll be many questions.
Our soapbox.
Yes.
I do think it's worth mentioning there is a downside for new investors in the ETF. I mean, ultimately, and hopefully that ETF's very good mechanism of trying to eliminate gains works, but you are getting a fund that has higher has a lower basis and higher potential tax gains. And so you're relying or hoping for the ability to move those gains out of the fund. If it doesn't happen, versus another ETF that wasn't created in the same way, they're the potential for higher capital gains. And so that's disclosure that you would normally see in a registration statement. And an investor, obviously, it's something that you are going to depend on the efficiency of the in-kind create redeem process for purposes of eliminating those gains. Otherwise, you'll experience them.
Yeah, I would just say that some of the 351 planning calls have a lot of them can have a lot of different lawyers from a lot of different specialties. So I think more than you want to talk about just like how you have to work with, the different, 40 Act counsel, working with tax counsel, working with all these different people just to make sure everything kind of flies smoothly.
Absolutely. Tax counsel, of course, obviously this is a tax matter, but you end up having 40 Act counsel. You have counsel for the advisors trying to make sure that they get the proper consent necessary to invest for purposes of their client. We have some parties that are actually pooling assets and for purposes of creating this control group and contributing, and they have their own lawyers. And so they're layers of lawyers. And then the accounting firms are obviously tax experts, and they have their own crews. And so all these groups have to be sort of aligned in terms of what's happening. And then ultimately, there's typically a tax opinion that gets to where someone has to sort of agree to a set of terms and conditions where there's enough comfort where you can move forward.
And then just one last point, which is that people have been asking me about tax lawyers that they can work with, and I would just say that it's very likely the trust that you're working in has a tax auditor, very likely could be Cohen. And so that's someone that you could start the conversation with as well.
Yeah. Elizabeth, what else from your soapbox?
Well, I feel like we're making it sound like this is an absolutely traumatic process. It's labor intensive, it really is, but I think on our prep call, I think somebody said 120 of these. So in 120-ish instances, asset managers have decided that disruption to business, all of this stuff, subjecting your process to lots of lawyers and auditors and everything, it's still worth it. I mean, this is still a really, really effective way to scale tax management, consolidate operations, and ultimately better serve taxable clients in a lot of cases. So as eager as we are to be like, go into it with your eyes open, definitely do that. But I think in many cases it's very worth it. And again, we're seeing asset managers sort of solve very long-standing operational frictions while also having the benefit of entering the ETF industry with, hundreds of millions instead of sort of starting from scratch and working on that trickle that we all know is really difficult. So despite all we've said, this is still a very
we never
worthwhile
really discussed the
exercise.
upside.
Yeah, there is upside.
And as the more 120 deals, it gets easier and easier and easier as it goes forward. Lots of advisors with SMA businesses want to be ETF providers, Elizabeth was saying. This is a great entree to a fund with size and a track record. Like you might even be able to bring your track record over, which, getting through the gates is one of the hardest things for new ETF providers. And so this may be a means to step right into the fray. There are providers, such as the folks, such as SEI, that will, because they have a platform, they're able to bring parties straight into the business when they haven't been ETF advisors in the past. So there is a great opportunity here, and to defer taxes, for some time, or perhaps even completely, is super attractive. So this is something that has legs for as long as the SEC and IRS allow for it.
Right, and the benefit really is, what if as a portfolio manager you did not have to think about negative tax consequences to your SMA holders when you were making a portfolio management decision? That's why you're interested in this. Okay, any questions?
That actually wasn't the soapbox.
That wasn't the
No,
soapbox?
I have a different
You still
soapbox,
need your
actually.
soapbox? Do your soapbox.
The intended soapbox was actually just, if we say that the conversion process is labor intensive, again, that's only half the battle. The next part, as Raphael was alluding to, is now you have an ETF, and the magic of the ETF, the tax efficiency that is going to bring tax efficiency during the shareholders' holding period. That's capital intensive, and the capital comes from the market making community. So I think it is a risk sort of taking for granted that all of that balance sheet is going to be available, at the outset to accomplish tax relief once you have a live ETF. Because again, at an individual level, the cost basis kind of ceases to be the shareholder's problem to deal with. Now it's the ETF's problem to deal with, but you can only deal with it with the help of the street. So I think, that's an education process that we spend a lot of time on the front end. If you're a large global asset manager who primarily trades with firms who really aren't in the ETF market making business, who don't have balance sheet that they make available for SIBs or what have you, you really need to start talking and kind of opening the kimono to those firms early on, because they're absolutely essential in kind of delivering on the promise that brought you to the ETF industry in the first place.
Yeah, absolutely.
Okay. Any questions?
I have a two-part question. Thank you, Liz, by the way, for your soapbox. That was great. And to the rest of our distinguished panelists for bringing a tax conversation to actually be exciting. So I wanted to ask you, Jay, or maybe the other panelists, about diversification on the way in. So it's kind of a two-part question. I guess the first part, second part really doesn't matter, but if an SMA is holding a diversified ETF for a long period of time, and they want to use that as a contribution to a new ETF, does that pass diversification?
In most cases, yes.
And the next question is, what's to stop an SMA manager from using the exemption that would allow them to in-kind transfer their securities through an AP to create an ETF and then in turn deliver that into a new ETF? I guess instead of doing the 351, is that a way around it? I'm not trying to talk people out of the 351, but could that, if they had the right facility, allow them to move securities using the custom basket relief to create an existing ETF and then use that existing ETF and deliver it in for whatever said new ETF is?
I'm sorry, I didn't quite follow all the steps of your
So-
hypothetical
so
transaction
when-
That was
there.
4D, Chris. We're not there yet.
Yeah, so
Yeah.
like when an AP creates, it's we deliver it in kind,
Yeah,
and
yeah.
we receive the ETF. It's not an event,
Yeah.
right? Well, a client of an AP can do the same thing as long as it's a bona fide creation and redemption.
Of course.
And in 6011, the manager can create a custom basket that is reflective of the holdings but not exact. So if, let's say they own 25 stocks and the manager says, yeah, we can actually take those 25 stocks in a custom basket, give you ETF shares back. Now the SMA holder now just owns a new ETF with the taxes still embedded, but not realized.
The control test is your issue. The shareholder would need to have 80% control of the new ETF in order for tax to be deferred.
So it works better for a brand new ETF. That
Right.
isn't, so you end up having to have 80% of the assets go back to the contributor. But if you can pass that test, and then also you have to worry about the fund-to-fund rules. So you'd have to think about, are we complying with Section 12D1 and the 12D1-4 requirements, because fund shares are transferring to another fund. But if you're talking SPY is a monster. It's so big that you probably don't have fund-to-fund limitations. There are rules that allow for that without even agreements. But yes, you could actually do what you're contemplating.
It's kind of like, imagine if I had a highly concentrated portfolio that wasn't diversified. I have 3 stocks, right? Manager says I can actually make a custom creation basket to take those 3 stocks in and give you ETF shares back. The manager then has to deal with the rebalance. Now that's just a regular standard
It's a taxable
non-351.
transaction to the shareholder.
That would be?
Yes.
But if it's SPY, for instance, using, that's diversified. And so if in fact you satisfy the other tests, the control test in particular, yes, you could do that without a taxable gain.
Thank you.
Hi, and first off, apologies for the TurboTax level quality of this question. So I'm an SMA holder. My advisor wants to launch an ETF. I get my assets in. Great. I now have shares of the ETF. my cost, say, is $10, ETF share price is 20. So I still have this $10 embedded gain. As the ETF works through creation redemption process and unloads the low-cost basis names and reduces their tax liability, as a RIC, do I still have that $10 embedded gain?
Yes.
Okay, there we go, asked and answered.
Yes. So the way that the reason that you do is because the ETF is not required to make capital gains distributions when it's doing the create redeem process, right? So no cash to you, you still have the $10 basis in, and the market value goes up, and eventually that will come to roost, but not today.
But the benefit is that your portfolio is now rebalancing rather than being stuck in that original set of assets.
This is not related to SMA conversions, but I don't know any tax people in the ETF space, so I'm just going to throw it out there anyway. Okay.
Go on.
We're seeing a lot more derivatives being placed in ETFs, and does that create any type of complexities, or from the tax side, obviously, with on the creation and redemption piece around options being bought and sold?
Fortunately for Jay's career prospects, yes, it creates quite a bit of there's quite a bit of tax complexity there, and so I think the fuller answer to this question would take hours, if not days. But suffice it to say that yes, and depending on the type of derivative and what the underlying is, there's a lot of tax implications, and we're so grateful to have people. There are people out there who know all that stuff, and you have to spend a bunch of time just kind of making sure that you're on the right side of the rules to avoid adverse tax consequences.
So yes, so I'd say this. So yeah, absolutely, it depends on what the underlying is. There are ways around it in terms of depending on what the underlying is, how you could structure it. If you're a commodities trader, we have some funds that use a Cayman subsidiary in their ETF in order to accomplish that. There are some derivatives that are qualifying assets for purposes of the RIC rules, and some that aren't. Remember, these rules, the regulated investment company rules, were written decades ago for open-end mutual funds that held equity and fixed income securities. They weren't written really for derivatives, and so a lot of times we're kind of trying to round peg square hole some of this stuff. But the basic analysis you have to do is it a qualifying asset, meaning is the derivative or the underlying of the derivative a security for purposes of the 40 Act? Okay, that's step one. And then step two is what do you want to do about your distributions? Because your distributions are calculated on a tax basis. Some derivatives can be in kind or can be redeemed in kind, and so you can use the benefit that we've been talking about. Some can't. Some there's tax on the way out. When that happens, it's a mark-to-market transaction. And so likely your distributions are going to be affected by this, and that becomes more than anything else a shareholder communication exercise. So, I don't feel great about not giving you a solid answer other than it depends, but it really does depend, and we need to know the specific types of securities and be able to talk you through both of those things, the qualifying asset test and the distribution test.
I will say that that question is central in the creation of these products, and so absolutely, what the tax impact will be for the exposure is very much considered, and whether I choose a flex option that's based on SPI versus SPX is part of the math, right? Thinking about the implications of the underlying asset and what impact it may have on the tax consequences of the product. So it is definitely part of the creation process, and as Jay was saying, the different assets are treated differently. But there are some very efficient structures. For instance, if you look at the buffer suites, I don't believe they distribute capital gains. I don't know if they ever have, or they
Don't.
perhaps
Usually they don't.
Yeah, and so they've found a way to do that efficiently, for which I think there are probably 300 plus of those funds right now using derivatives for their whole portfolio, and found a way to make it work.
Cover calls, other kinds of option strategies, overlays, we talk about all of those.
Question here.
Oh, yeah.
Hello, everyone. Thank you, panel, for talking about 351 exchanges in, I believe, a very clear way, because it's obviously a very hot topic right now. It's nice to even see it as a panel. The first time I've seen that in the conference, so thank you all. I have a question for you about, in relation to the investment thesis discussion, and the strategy coming in to the SMA or the SMA strategy and what the outcoming ETF needs to be. So in particular, these announcements of the Cambria and Stance ETFs that are coming, which in theory could be hundreds, if not thousands, of just individuals contributing a single security that all of a sudden becomes an ETF. How do you make that argument that there was a previous strategy at all, and then the subsequent ETF strategy? I'm just curious what your thoughts are.
Deep
I'll
breath, panel.
I'll start. I mean, ultimately, we have rules, right? And so in order for 351 to work, you have to have a contribution of a diversified pool, right? And so that sets the stage. You end up having a fund, like, for instance, let's say your fund is U.S. large cap equity. It could contain a lot of things and still function. I'm assuming that if you are taking assets from a range of sources without one consistent investment theme, that the ETF you're creating has a broad mandate, and the assets would have to fit within that broad mandate. So it'd be different than a very sort of particular SMA strategy just being converted in ETF. You'd have to start with a broad mandate and have it work. The question I have is, does anyone want that fund once it's out there and trading? If you wanted a broad mandate fund, you could easily buy a very inexpensive index fund to do that. So the question is, will those funds be popular and trade after the contribution? And I guess we'll see.
Yeah, I think from an asset manager, if you have a client that you're trying to implement a strategy and the tax cost kind of makes it difficult to rebalance, that's a kind of easy kind of benefit to see for being able to rebalance after the post 351. I'm not going to talk about that product specifically, but for the RIA community generally, we're getting questions from RIAs talking about this topic. I would just say that suitability never comes up, which is kind of weird because should be a key concern for advisors when they think about what they're doing with their client assets. And to Morrison's point, at some point you have to worry about what is the product you have after the fact. And so I would just say that to the extent you're thinking about contributing your client's assets as an RIA, you just have to worry about the suitability. I think there's no part of that conversation is to discuss suitability. That's something that we're discussing with advisors that we're working with. So.
I think it's a strong point. Most of these assets are held by advisors. There's a fiduciary duty. Ultimately, it has to make sense for the investor to move the asset into this other vehicle. It's just part of the math.
Yeah, I mean, the first few minutes of this panel, we were just trying to make clear what a scramble this exercise is, even with 120 reps under the industry's belt. So, I mean, we have a lot of questions about how is this exercise scalable as a product feature, leaving aside just operationally, and then leaving aside a very important question like that. Like, what is the relationship of what's being contributed to the investment thesis, which, by the way, would have had to pass muster with the SEC to some extent. And I don't know well enough if the SEC would just look at this and say it's a kind of rudderless ship, and that's fine if investors want it. But I think that's a smart question that the innovators behind those products will need to answer for us. So we'll be watching.
I think we got time for one more.
A question. First of all, thank you so much for this panel. What interesting and timely topic. Based on my personal experience, if as a taxpayer, your highly regarded tax professionals prepared the whole return for you and made some significant mistakes, years later, if IRS finds out the mistake, ultimately it's the taxpayer's responsibility for all the fines and tax payments back, right? And from what I'm hearing, this whole exercise of 351 planning is rather complex from tax perspective. And did I hear if any mistakes is made along the way, years later, it will still be the investor's responsibility for all the potential fines? If that's the case, and it's so complex, so many parties are involved, how can we as financial advisors to assure the investor this is still worthwhile, and any way to prevent that kind of risk to really happen to the investor.
It's either you or me.
You know what, I'll start. It is something that there is risk. And ultimately, you'd have to believe that the parties you're dealing with know what they're doing, and you're relying on professionals and their advice. I would say work with people that know what they're doing. And if the risk seems too great, then don't do it, right? I mean, ultimately.
Yeah, that's right. It's up to the individual to decide whether they want to assume the risk and to consult, qualified advisors. And just because you've consulted a qualified advisor doesn't mean the IRS won't challenge that position down the road. They could. So, be comfortable, as Morrison said, with the risk you're taking.
And then I don't want to put words in Jay's mouth, but as an auditor, I think that the auditors are going to, kind of be curious at who's writing your tax opinion from the advisor perspective, right? And so it's not
definitely
just
one of the steps we follow.
Yeah, so it's certainly not the case that depending on who your auditor and the tax attorney for the that's advising the advisor, there should be some controls in place there to help significantly mitigate that risk so that you get a clean tax opinion that creates a clean audit that significantly reduces the risk.
Okay, on behalf of Cohen & Company, I'd like to thank Steve for having us here and thank my panelists.
Thank you. Thank you very much, Jay.